Welcome to the BIP Ventures Extraordinary Pursuits podcast, a fascinating and inspiring journey into the world of venture capital and startups. Each episode offers masterclasses and entrepreneurial stories from some of the top minds in the innovation economy. Get ready to unlock new ideas and gain valuable advice for how to thrive as an innovator and an investor. On this episode of Extraordinary Pursuits, we welcome John Thaxton, the Vice President of Client Engagements and the co-founder of SOAR Performance Group. SOAR provides transformation enablement and training to help companies differentiate and win in their markets through improved customer and buyer engagement. John leads client relationships and supports the strategic direction and operational management for the company. He's a sought-after speaker and panelist on the topic of B2B sales. We're so glad to have him with us today. Let's get started. Hi, John, and welcome. Thank you so much for joining us on Extraordinary Pursuits. We're glad to have you, and I would love to just go ahead and get started with a brief introduction. Can you tell our listeners a little bit about yourself and a little bit about SOAR?
Would be happy to. Thanks so much, and really appreciate you having us here on the Extraordinary Pursuits podcast. So my name is John Thaxton. I'm CEO of the company SOAR Performance Group. So we help organizations drive value-based approaches across marketing, sales, and success to help them drive predictable, repeatable revenue growth, which is what investors like BIP are looking for. So we get a chance to work with a lot of the world's fastest growing startups and scale-ups on helping them perfect their revenue processes.
Wow, that is awesome. I'm sure that you are incredibly valuable to an incredible number of companies, including the ones that will be listening today. So today we are going to talk about some of that counsel that you give to those companies, but we're going to start at the very earliest stage, and we're going to talk about KPIs in particular. For our listeners who maybe don't understand, what a KPI is, what that acronym means, and why they're important, especially for these early stage companies. Can you give us a little bit of an explanation, a little bit of a backdrop?
For sure. So, a simpler word for KPI might be metrics, but it's really key performance indicators. So KPI stands for key performance indicator. That is really what are those things that are telling us that the business is performing in what way over what periods of time. And so the reason that's important, like at the highest level, is obviously if you're listening to this podcast, you're probably either venture funded or aspiring to be venture funded. One of the biggest reasons that matters is that's what investors are looking at. So when investors are deciding if they want to invest more in your company, if they want to invest in your company at all, is your company investable? That's one of the biggest things you're going to be looking at are your key performance indicators. And so that's one of the reasons we believe it's important. But beyond that, from a more company-facing perspective, it really allows you to drive alignment on what's important for the business to perform well and how do we need to manage and drive the business to achieve the results that we want.
Got it. Okay. Yeah, measure what matters, right?
100%.
100%, right. So at what stage, we've talked about it being kind of early stage. You've mentioned that, but how early should a company be thinking about what these KPIs are, particularly in sort of that revenue operations kind of, lens?
100%. That's a great question. And I think very, very relevant. I would say the sooner the better, and for the following reason. So we get to work with a lot of companies on their startup and scale-up journey, and it's sort of like building the foundation of your house. If the foundation of your house is good, as you get bigger, as you add more people, as you add more different products, as you add more go-to-markets, if you have a good foundation, then it's a lot easier when you start to scale. If you don't have a good foundation, if you don't have either a good data foundation, if you don't have good definitions around what your KPIs are, if you don't have a good understanding of what we're measuring and what we are kind of managing across the business, undoing that and redoing it gets harder the further along you get. So this feels like something that maybe should be for a bigger company or a later company, but what we see over and over again is that investment to do it right early on saves you a lot of pain down the road.
Okay, so that brings up a whole bunch of other questions. And, I think that, the first one that comes to mind for a really early stage startup is how do I even know what to measure.
For sure.
What KPIs are the most important? So if
Yeah.
you're starting from nothing,
Yeah.
where should you start?
100%. So I think the first thing you want to look at is what we refer to as your lagging KPIs. So these are the results that we've gotten, kind of the more results oriented KPIs. And there's four big categories. And so the specifics of how you slice and dice this may look a little bit different depending on your business model, what you sell, who your customers are, all that. But at the most basic level, everyone's going to have some sort of a revenue KPIs. Like, did we hit our bookings target for the quarter, for the month, for the year? So like revenue, and are we hitting our revenue goals? We want to understand how are we performing compared to our expectations and our investor expectations is really the question that's answering. The second question we want to answer is, are we setting ourselves up to perform in the future? So that's where we really want to measure pipeline. So how much pipeline do we have? How much pipeline do we have? There's a lot more you can dig into in terms of pipeline metrics, but you want to have whatever the right proxy is for your business around pipeline creation and pipeline coverage. And do we have enough pipeline for the future quarters? So that's the second. So first is revenue, second is pipeline. Third is retention. So are we retaining and growing our customers? So the third question we want to answer is, like, once we have customers, once we've converted them, are they growing? Are they growing? Are they expanding with us? Are they staying? And then the fourth is some sort of an efficiency metric. And so bigger companies will look at something like a CAC to LTV, so your customer acquisition cost versus the lifetime value of a customer. That's really hard to measure when you're first starting because you don't have customers for that long. It's really hard to figure out your customer acquisition cost. But a couple other more interesting proxies, I think, for younger companies is your bookings divided by your total sales and marketing expense. So like, what's your overall sales and marketing effectiveness ratio? And the other one that can be really helpful depending on your go-to-market model is like your productivity per rep. So like, what's our overall productivity per AE or per resource? That can be another helpful efficiency metric when you're early on.
That is so helpful. So there are four core KPIs, just to sort of summarize: revenue, pipeline, retention, and efficiency, just
That's right.
categorically speaking.
Categorically
So
speaking.
yeah, categorically speaking. So you've mentioned a couple of equations. Are there specific equations that a startup that is saying, okay, great, these are going to be my four pillars,
Yeah.
and I'm going to measure these things? Are there some standard equations for each of these four? You've mentioned some, but across all of them,
Yeah.
are there resources that a startup might be able to say, okay, I'm going to use this equation just to know that I'm performing the way I need to?
Really good question. So it's funny. So the answer to that is like yes and no. So there are standard ways. There are standard ways for people to think about each of these, but I think what most people find as they mature in their journey is you've got to tune these to fit your business. And so I'll give a couple examples here. So on the revenue side, that's pretty straightforward. I mean, that's basically what did we book in a quarter, a month, a year. That was not so complicated. When you get into pipeline, there's a lot that you can measure and there's a lot that you can start to look at. And so one example of a common thing you'll hear is pipeline coverage. Which pipeline coverage refers to how much pipeline do we have compared to our quota. So how much pipeline do we have that's forecasted for this quarter compared to our quota for the quarter? Or how much pipeline do we have for the year compared to our yearly quota? What's our yearly goal? Kind of how does that look? And so that, just as an example, is a place where you really have to understand what's your historical conversion rate. Because a lot of times people say, okay, you need 3x pipeline coverage. Well, if you have a really high close rate, you might not need 3x pipeline coverage. It'd be nice to have it, but you may not need it. If you don't have a high close rate, which is very probable as you're early on in your journey, then you're most likely going to need more than 3x pipeline coverage. And so one of the things that I encourage folks to think about is there's a lot of kind of rules or guidelines that you'll hear, but you've got to map that against like what's our historical experience, our historical expectation. And so pipeline, as an example, folks are oftentimes talking about what's our pipeline coverage ratio. A lot of times you hear 3x as a goal, but with a very big caveat that you've got to dial that into your sales cycle, your kind of prospect type, and how your business works. On the retention side, on the gross retention, I think most businesses are shooting for 90% or higher gross retention, 120% or greater net retention are sort of the benchmarks that I think investors start to get really excited about. Just to break that down, gross retention is going to be literally who did we have as in our customer cohort this time last year versus who is in that cohort this time this year. So if we had 10 customers last year, Now we have 9 customers. That's a 90% gross retention. You can also look at that by dollar value. So if we had, $100,000 in customers this time last year, we now have $90,000 out of the same cohort. That's a 90% gross retention. Net retention is both what we keep, but then also what we expand. So that then includes things like cross-sell, upsell, expansion revenue, which then gets us into what have we started to expand. Now, a lot of organizations think of NRR as an important metric because it is very important to investors. Investors care a lot about NRR, but you want to measure both gross and net, because if you have a couple big expansions or a couple big upsells, that can actually mask quite a bit of logo churn. But from a retention perspective, kind of the benchmarks that investors start to get really excited about is 90% gross, 120% net. And then on the efficiency side, that one is widely varied. Like there's not a lot of standards on that. You'll hear things around CAC to LTV and kind of where you want that to be from an investor perspective. But for an early stage company, your efficiency is going to be sort of all over the board because you're figuring it out, you're learning, you're not yet at the place where you found maybe product market fit or repeatable go to market. You're on that journey of searching. And so you're not likely to have a standard metric there. The reason we believe it's important to start tracking it is, one, investors do really appreciate it. So number one, they appreciate the focus on efficiency. And number two, it helps you understand at a macro level, like, is what we're doing working? If we're spending $1 million on sales and marketing and we're getting $100,000 in bookings, that's not great. If we're spending $1 million in sales and marketing and we're getting $2 billion, that's awesome. So it kind of gives us an idea of like, is what we're doing working or not?
Wow, that is, I understand why people hire you. That's very complex and so many considerations there. So you've mentioned a couple of times, you've sort of said like what investors like to see. And I think that you've done a really nice job of sort of clarifying some of those things. So if you have a company that is just getting started, building their own metrics, are there specific benchmarks against which they can begin to measure their own performance? So say you've got a startup that's thinking about pitching for capital and they're preparing for those conversations. Are there resources available that startups might think about to know like, hey, okay, I'm tracking these things. Does this look good against the benchmark 100%. So that when I walk into that room,
there is. I'll offer a couple of resources that are free and online. Okay. So Insight Partners has what they call their periodic table, which is a great resource that kind of gives you across their portfolio what are their companies benchmarked at different revenue types and things like that. That's a great resource. So if you want to see how do I compare, that's a great. Even it's much more exhaustive even than what we've talked about today. But it's a great, I think, resource for folks. Another one I'll mention is. Another one I'll mention is the KeyBank Private Capital Markets Report is a report folks do that's sort of a KeyBank's one of the investment banks. They do it every year. It usually has some really good info on things like go-to-market efficiency, go-to-market metrics. There's a lot more depth and breadth in there. But yeah, so those are a couple of good resources that can give you some good benchmarks.
That's awesome. Thank you. I know we have a number of our listeners who are fairly early stage, so it's great to offer those resources, and those are really credible.
And they'll get more. We could talk about that for probably 4 or 5 hours. So I think it'll be easier to go to those resources than to talk about it for sure.
No, absolutely. Okay, so what have you found holds companies back from setting, or probably even harder, keeping their KPIs?
For sure. Well, I think there's two sides to this. So there's the lagging side, which we just talked about, which that, especially if you have investors, that sort of gets taken care of through your board reporting process. But the big thing in terms of like holding back on the lagging KPIs has more to do with building the right data foundation and the right sort of RevOps foundation, and making sure that you have setting your KPIs and then setting your systems up in such a way that they report on that information consistently sounds really simple, but is remarkably difficult and is incredibly hard. I mean, I think there are companies that we work with that are, let's just say 10 to 20 million in ARR, maybe even less than that, maybe even 5 million in ARR, that have almost an FTE that all they spend time doing, like one FTE, all they spend time doing is pulling and preparing the board decks. And so that just gives you an idea of like this sounds simple, but is a very painful process, especially as you scale, if you don't build your systems and your RevOps foundation in a way that the data is consistent and easily reported on. Now, I think the more interesting part when we talk about driving performance is not actually the lagging indicators, but the leading indicators. And so that's really where we get into what things can we look at that predict success. And this part is where really elite companies that perform super well, the ones that you see that become unicorns at IPO, a lot of what they've developed is predictability around their revenue model. And a key aspect of that is understanding what are the leading indicators of revenue and what are the leading indicators of retention. Now, this is where things get really, really hard because it takes a lot more than just pulling some reports to look at this. You have to actually understand your business process, understand how your revenue process works, and then work backwards to understand what activities then predict success and what's the cause and effect between those activities and that end result. So here's some examples kind of the end product, and then I'll talk a little bit about like what goes into creating that. So we have a customer, they sell an AI solution into banks, and they basically know that if every one of their AEs creates 2 opportunities per week, that AE is going to hit quota. Like over time, they have found that like that is the magic formula for what their AEs need to do to hit their quota number. And the great thing about that is it's very simple. It's very understandable. Everyone can get like, are we doing the right things? Are we on the right track? Your managers can manage to that. Your AEs know that's what I need to do to be successful. And that creates a very repeatable model. In a different kind of framework, we have another customer, they sell a sales and marketing technology. They have a really large deal size, so they sell into large enterprise accounts. They have, kind of a, let's say, high 6, low 7-figure deal size. What they found is for their reps, if they can get a 1 prospect per month into a proof of value, which is like a POC, basically a proof of value activity, then they are highly likely to hit their goal. There's like a 98, 99% correlation between if a rep gets 1 prospect per month into a proof of value, then a very high likelihood that they're going to hit their goal. So that's when we talk about leading indicators of revenue. It's what are those activities that we can point to that we say, hey, if we're doing enough of this activity, then we're going to get the result that we want at the end. Because especially when you think about managing a go-to-market organization, you can't manage results, right? Like you can't actually make someone buy anything. You can only manage activities. Like you can only manage, are we doing the right amount of pipeline generation? Are we executing our sales process well? Like, are we doing the things that we need to do in a consistent format to achieve the result that we want? And so what that means, and this is a long way of answering your question, is like to actually get predictable, you have to be really disciplined around business process. And that's just really hard work. Like it's really hard work to be disciplined around your go-to-market processes. And I also think it's not the primary passion of your average founder. Like your average founder didn't create a technology company because they want to be super disciplined around their go-to-market and revenue processes. And it oftentimes takes a few different tries or attempts before they find the right leader that can help jive with them to put a lot of this in place, or before they find someone like us that can help go along that journey with them. This is not usually why your average founder got up and started their company. So like, I think when you talk about why is this hard, I think the reason it's hard is to get predictable, especially around revenue, is really about process discipline. And do we have a good understanding of our processes? Are we executing those consistently? And it's hard work. Like it's hard work. There's no shortcuts.
Yeah. Yeah, no, I think that that's really true. And, we see so often, with startup companies that, they have been, the founder is maybe from a technology background or maybe from a marketing background, but they get into having to do the books,
Yes.
the talent, the KPIs,
Yeah.
all of these fundamentals that is not why they got into business. And it's a little bit of why we're here, but it is really hard. I was an entrepreneur, and one of the reasons that I sold my company was because it came time to grow, and I had to do books differently, and that was not something I was going to do.
You weren't excited about it. You were like,
No.
I've had enough.
I've had
100%.
enough, and honestly, I only know enough to be dangerous. So I think having resources like you is great. I'd love to just maybe pull the bus over for 1 second and have you give a really brief explanation of the difference between lagging and leading indicators.
For sure.
Just because we've referenced them a few times, and I want to make sure that our listeners really have good clarity around the difference between the two.
Yeah, that's a great call out. It's also something I talk about a lot, so I probably didn't do a great enough job of setting the basic foundation. But your lagging indicator, the way I think about your lagging indicators is you're reporting the news, right? How did we do in the past? Like, how do we do in the past month, the past week, the past quarter? Like, it's all going to be kind of rear view mirror focus. Your leading indicators are what are the activities we're doing that are setting us up for future results. So, like, what are the things that we can see that are telling us what direction we're going as it relates to the coming quarter, the coming month, the coming year, whatever that time horizon is? What are the things that we can look at that tell us that we're moving on the right pathway? Whether that's pipeline creation, whether that's pipeline conversion, whether that's a certain type of activity that you want to link to, like we discussed about opportunity creation or getting customers into a proof of value exercise. On the retention side, same thing. You can look at things like, hey, what is their first time to value? We have a customer in the cybersecurity space that wanted to look at how do they drive better retention of their customers. What we found, we kind of dug in, got under the hood, is customers that had at least 2 use cases deployed in the first quarter, almost 100% stayed. And if you didn't get to that in the first quarter, like, very unlikely to stay. Like, or the churn was much higher. The churn was like 77. Their retention was like 70% in that cohort. Retention was almost 100% in the cohort if they get 2 use cases deployed in the first quarter. So that's a great example of leading indicator, right? Is we want to figure out, are we going to retain this customer a year from now? The leading indicator is, have we gotten 2 use cases deployed for them in the first quarter? And so the other thing that's nice about leading indicators is they're usually activity based. So it's something you can manage to. So when we're thinking about, in this particular example, implementing a customer, we know that we need to focus on getting at least 2 use cases deployed with them in the first quarter. That makes it easy for our CSM team to know, like, what is the goal line? Makes it easy for our implementation team to know, how do we make sure we coach this customer along their journey? And it's also something we can start to set up with the customer to say, look, our goal with you is to get 2 use cases deployed by the end of our first quarter together. Can you help us make sure that we hit that goal? So we talk about leading indicators. It's really things that are telling us that we're ultimately going to achieve the result that we want.
Perfect. That was such a good, crisp explanation. Thank you. So kind of getting back on to the topic that we were sort of going into, you've talked a lot about just the enormity of this effort to know how to set these up and to really stay on top of them and be able to answer these questions when asked at any point, all of that. Is there sort of a Goldilocks situation between how much data, you're ingesting versus
Yes.
how much is actually useful?
Yeah, that's a great question. And so I think the way that we usually think about that is not to focus on what data do we need, but what questions do we want to answer, right? Because if you start with what questions do we want to answer, then we can figure out what information do we need to answer those questions. But the questions that we believe are really important from a lagging perspective is, are we hitting our revenue goals that make us attractive for our investors or other investors? Are we creating enough pipeline? Like, are we setting ourselves up for success in future quarters by creating an adequate amount of pipeline? Are we retaining and growing our customers in such a way that we're going to have long-term success and viability? And are we doing that in an efficient spend rate in terms of how we spend our money? I mean, at the end of the day, we think those are the 4 really big ones that you need to be able to answer that help everyone get clear. Now, when you get into the leading indicators, then you can ask a bunch more questions, right? Which is like, how much and what type of activities do we need to do to hit our goals? Like, what type of activities do we need to do to hit our goals? How much of those activities do we need to do? How do we calibrate that effectively? That becomes the types of questions that you can ask when you get into kind of managing your leading indicators. But from a lagging indicators perspective, we think it's really simple. There's 4 core questions. Are we hitting our goals and targets in a way that's going to make us attractive to our investors and future investors? Are we, creating enough new opportunities that we're going to have success in future quarters and years? Do we have the right customer retention? And then are we doing that in a way that's capital efficient?
So those sound like yes or no questions, pass fail.
Yes.
Is that the case, or is there a situation where it's more like an OKR, where you're really kind of aiming for that 80% because you know you've stretched enough,
Yeah,
but
yeah.
you got to get, a
For sure.
certain percent?
That's a good question. Yeah, and they're not really pass fail. That's not how it actually works in real life. Like they're not really pass fail.
Okay.
Yeah, they're not really
Yeah.
pass fail, but it's yeah, I think a better way to phrase it maybe how are we doing in terms of our bookings, our conversion? How are we doing in terms of pipeline creation for future quarters? How are we doing in terms of making sure we keep and grow our customers? And how are we doing in terms of doing that in a capital efficient way? I think is maybe a better way to phrase it because to your point, it's not pass fail, it's not yes no. That's a great way to describe it. And then from a data perspective, it becomes about what information do we need to tell us that, and then
Mhm.
in general, the other thing that I've seen is you can slice and dice it a lot of different ways. It's best to start out with like one dashboard per KPI, and then you can add more dashboards from there if you want to. But like I think pick the right, whether it's four, where you want to add a couple, make it five, make it maybe seven, however many you want. I would say definitely less than 10, but whatever your main KPIs are, have one dashboard for KPI, and then you can expand from there. I've seen it's amazing what technology can do, but I've seen young companies, companies with a few $1 million, maybe $5 million revenue that have like 100 different dashboards. And because you can create them all, because you can say, hey, I want to slice it this way, I want to slice it that way, I want to look at it this way. And ultimately what happens is you create a situation where you're not able to then communicate that across the different stakeholder groups. Because the other part of KPIs is about alignment. Like it's about aligning how are we doing as a business, how are we performing, what do we need to do this quarter, this month, what do we need to focus on? And when you get too many things, it's hard to have alignment. Like you can't, like your
Yeah.
average person can't digest all 100 dashboards. And to be clear, usually the person who creates the 100 dashboards is the founder because like they know everything about the business. They're usually tech savvy, and so like they'll end up being 100 something, whatever it may be. One of our customers literally had 100 dashboards, and looked at just it was really crazy. And the thing was, the founder was a genius, so he could tell you what was in every single one of those. The challenge becomes everybody else, right? Because now all of a sudden we're not working off the same set of information. So I think when we talk about KPIs, somewhere between 4 and 7, definitely less than 10, one dashboard per KPI, like pick it. And the other part is you can change it, but like change it intentionally. Like change it
Mhm.
annually, maybe maybe every half year. I would say annually is probably a better cadence, but you can change it. Like you're not beholden to it forever, but like pick
Mhm.
one, pick one dashboard per KPI, pick 5 to 7 KPIs, and kind of land there.
Okay. Keep it tidy. Keep it
Keep it
tidy.
tidy. Well, otherwise it's
Keep
just too. Otherwise it's just too hard for everybody to keep up with.
Sure.
And then after that, you can make it more complicated, right? But at the highest level, have one base set of information, and then if you want to slice it and dice it for different departments or for different use cases or for different purposes, like go ahead and do that. But when you get beyond that, it gets really hard to manage the group in that way.
Yeah, no, I can imagine that that's the case. Is that a risk that companies run as they scale, that they just
For
start
sure.
adding
Yes.
KPIs?
Yeah, yeah.
Uh-huh.
Well, they start adding everything. They start adding everything. So I mean, it is one of the big challenges as you scale up is um, there becomes more than you can measure. So like there's sort of this I'd say innate desire to figure out, hey, how do we measure all this different stuff? But to your point,
Sure.
I think at the end of the day, you've got to get back to what questions are we trying to answer about the business, and what information do we need to answer those questions that tells us where we need to focus and what we need to do. And like
Yep.
starting there and then working backwards to the information, I've found is a much better output than starting with the information and then trying to pare that down into what is this telling us. Because also, you probably realize this, but like if I go back in time, the amount of data you could capture was just less. And so you didn't have as
Oh
much
yeah.
noise. Now you can capture product data, customer data, interaction data off the internet, off your website. And so there's all this data, which is great. It gives us a ton of rich information. However, you can also fall into analysis paralysis where we're rat holing on so many different topics that are not actually helping us move the ball down the field. And so to what you were saying earlier, I think starting with the questions that you're trying to answer about how is the business performing and what do we need to do across departments to help make sure we keep performing well, helps prevent some of that bloat over time.
Yeah, yeah, that makes really good sense. in your experience, do you find that companies need to stop and assess if their KPIs, if some of their KPIs are wrong? I mean,
Oh,
is there
100%.
an
Yeah, 100%.
intentionality to that? Yeah.
100%. I mean, I think at a minimum, a yearly, I think at a minimum, some sort of a yearly evaluation is really healthy.
Yeah.
I don't know that, I don't, the short answer is, I think most people reactively set up their KPIs based on their board meetings, is I think the way that it works in practice. Like, I think there's a board meeting and then everyone sort of scrambles around to get their KPIs together. I think what I've seen really well performing, high performing companies do is they do a great job of being intentional about what they're measuring and changing it in a thoughtful way. So like whether that's annual, whether that's, every 6 months, those sorts of things. And there's also certain events that help you to know, like, do we need to change our KPIs? Like, for example, in a lot of cases, most businesses as they're growing have one predominant go-to-market motion when they're first starting out. So like when you're first starting out, you're most likely going to have either a direct sales-led motion or more of a product-led motion. Over time, you start to add things like channels, alliances, different segments, enterprise, mid-market, SMB. If you're product led, you may add a sales led component. If you're sales led, you may add a product led component. As that changes, that inherently changes like what you need to measure and how you need to break it down by segment. So I think the other thing that really smart organizations do is they do a good job of aligning their strategic changes and kind of their strategy changes with how they then kind of instrument and measure those things.
Brilliant. Okay. Okay. So it's all about just, assessing and orienting and,
For sure.
making sure that you're answering the questions that your constituents or
That your constituents
funders
care
are
about.
going to ask. Right.
For sure.
Exactly. Okay. Yeah.
Oh, and I think it's,
awesome.
and you've probably picked up on this, but the hard thing about a lot of this stuff is there's not a magic button that you push that all of a sudden this all just like works ideally.
Yeah.
If there was, we wouldn't need to do a podcast about it. But that being said, like there's not a magic button you push that all of a sudden it's like these are the things. And the other thing that I would say is dangerous is like you can read a lot on the internet about like what are good KPIs, what KPIs we think about, what KPIs do different organizations measure. But at the end of the day, you've got to figure out what works for your business. If you're a high velocity vertical SaaS company that sells to a very specific persona, high level, like revenue, retention, pipeline, that's going to look pretty similar compared to a lot of, in terms of what you measure. But when you get under the hood of that, what you're going to look at in terms of things like your pipeline creation, your pipeline conversion, your sales stages, aligning that with how your buyers actually buy, all those things, it's going to look a lot different. And so you've got to do the work to understand what are the key things in our business that we need to measure and how do we drive a cadence around making sure we're measuring those both from a leading perspective as well as a lagging perspective.
Okay. So it sounds like, if we were to sort of land on this point, it is really, sit down and ask yourself what matters most.
Yep.
What are the elements of that needs to be measured? What
Yep.
are the leading indicators and what are the lagging indicators? And from that, you really can begin to build out, something that you will go into a cadence of measurement with.
For sure. And the other thing I would say is like, don't break your brain doing it, especially if you're a young company. Like, don't break your brain doing it. Like you just start with some real simple things and scale it up over time. And the other part is like we said earlier, like if you're noticing, hey, I'm going to give a great example of like a good time to change or a good thought around changing. So we're just working with a company. They were really excited because they had put in place this gifting program. And so like their pipeline conversion went way up because they were basically gifting people to set meetings. So that was super exciting. Pipeline creation was way up. A quarter later, what they realized was that pipeline was not converting because just because someone takes a gift from you does not mean that they're a great buyer of your product. It just means that they wanted a gift from you. And so that's a great example of like, hey, maybe it's time to shift what we're measuring and not only look at, are we creating pipeline, but is that pipeline converting? And do we need to make sure that we have a quality metric in there as well? So like, that's a good example of, hey, they started out focused predominantly on pipeline creation. 2 quarters later, they were like, we've realized that we created a lot of pipeline, but that pipeline is not going anywhere. Our results aren't really getting better. What do we need to go back and fix? And so that starts to give you ideas about what do I need to double click on? What other things do I need to start to look at?
Yeah, no, that's incredibly perceptive. And I think, what I hear is that that's not just useful for the sort of timely decision making, but also as you are scaling and as you are
Mhm.
creating new products and bringing new things to market, whatever, you can look back and say, oh,
Yes.
you know what? Remember when we tried this and it didn't go well, or it did
Yep.
go well? How do we take that learning with us? So,
Right. Yeah. It's
um,
that's a yeah, 100%. It's
yeah.
something that also helps you. Yeah. It's something that also helps you learn learn from what you've done in the past. Yeah, for sure.
Yeah, you get your own earned knowledge and learned knowledge all in one. So
For
that's
sure.
awesome. Well, John, this has been so informative. I wish I had had you when I was starting my business years ago, but I didn't. So here we are. I'm glad to be talking with you.
Great to be
I guess
talking with
that's
you as well.
lining. Where can people find you?
Yeah, for sure. So you can find me at SOAR Performance Group, SOAR performancegroup.com. If you search John Thaxton on LinkedIn, that's me. And then my email is just first name, last name. So John Thaxton at SOARperformancegroup.com. If you want to reach me by cell, my number is 770-851-9758. So feel free to ring me or text me. Probably easier to text me than call me. But yeah, if we could be helpful to you, if we can help your business as you're on your startup or scale up journey, we'd love the opportunity to do so, and really appreciate the opportunity to be on the Extraordinary Ventures podcast.
Well, thank you so much for joining us. Thank you for all of the information that you have shared. And thank you for being so generous with your contact information. We will, I'm sure, be hearing from people with gratitude for all of the great information you provided today.
Thanks so much. Thanks for having me, and have a great rest of your day.
Thanks for listening to the BIP Ventures Extraordinary Pursuits podcast. Check the show notes on our blog for the resources we discussed. You can find Extraordinary Pursuits on your favorite audio platform. Be sure to subscribe to the BIP Ventures YouTube channel and connect with us on LinkedIn, X, and Instagram so you get all the stories, learnings, and ideas for ways to thrive in the innovation economy. And if you liked this episode, be generous. Share it.